take a look at the technicals. Join us now, Katie Stockton, Fairlead Strategies founder, managing partner, and a CNBC contributor, and she actually admits that she contributes here. 5,000. Is that a resistance level now?
No.
What's the resistance level in S&P?
I looked back at past sort of round numbers like this in a very non-scientific study and found that it did not act as resistance in the past. So 4,000 kind of blew right through that. 3,000 did the same. So I don't think it's a really big threshold except psychologically. Although I have to say, remember when Treasury yields inched up around 5%? That did become a resistance level, of course, for yield. So there are times at which those round numbers matter a whole lot. But in this case, I don't think so. We still have such strong momentum behind the market across time frames. And I think that's what we want to respect.
It's been confounding a little bit. I wonder about sentiment. Is it positive now? Because all last year it was negative, and we love walls of worry and things like that. Sentiment gets too positive, you have to worry. But lately there's been, I will say, like negative news in the market just seems to melt up by the end of the session. Like 150 points on the Dow is just like, the Dow seems to be good for that almost every day for the last 6 weeks.
You know, I think you can see that the sentiment isn't overwhelmingly bullish in the small caps, right? Or surrounding the small caps. That you all have been showing a lot of guests that talk about breadth being so negative. Quite frankly, it's really not that bad. We've seen digestion in those breadth metrics, which is very natural after a very, very strong breadth surge in Q4. So that bearishness, that bearish camp is sort of gravitating towards the area of the market that's not working, which has been small caps, but really only for a few weeks. And I think that within the next week or so, we will see Treasury yields probably top out in this oversold sort of relief rally that they've had, and that could occur to the benefit of the small caps. And all of a sudden, we'll look back and say, well, that's a pretty good entry.
The Magnificent Seven went to the Sexy Six, to the Fantastic Five, or was it Fantastic? What's the superhero?
I have no idea what you're talking about. I think
the Magnificent,
the biggest market cap companies in the market. Just
some of them have fought. You weren't here. We had the discussion earlier this week that it's no longer 7 stocks. What do we decide on? There's 4 or 5 now, Andrew, in the Magnificent Seven.
The Fancy Four.
Fancy four. Does that matter? We've dropped out. The leadership is narrowed, hasn't it?
We still have very good leadership, but what we've seen is expansion in leadership on the sector front, especially. If you look at the top sectors year to date, it includes healthcare. And that's sort of a new sort of arrival on that front. So as long as we have that breadth expansion on the sector front, I think it's an uptrend that can sustain itself. Financials have really kicked in. Again, the bearish camp is gravitating towards the regional banks and the pullback there. But if you look at the broader financial benchmarks, they're still very strong.
I mean, the market has continued to trade higher as that really dovish scenario that 6 weeks ago people were talking, 7 cuts starting in March. That's off the table. And you saw Jay Powell on 60 Minutes. The market's continued to trade higher. What does it say about the 10-year? What's the... Is 4.5 in the cards or 3.5?
I would say low 3s is very doable from a technical perspective. I don't know why, and that's the hard part.
It's just that the jobs market is so strong and the GDP numbers are so strong. I don't know why yields would go down.
So for me, from my perspective, there's a very meaningful loss of upside momentum that we've seen there. I don't think this is a secular downshift. I think we've seen a secular upshift.
In yields.
In yields, right? I think this is something that could be impactful this year, maybe some into next year to some degree, based on our indicators. That loss of long-term upside momentum is such that it could be maybe 9, 12 months before we get sort of a low in yield. So we're seeing this as corrective, but something that should persist. And if support, which is roughly about 3.8 to 3.9 right now, is broken, then the low 3s would be
well, unless we get a really more inverted yield curve, then the short end is going to have to come down, and we're going to have the cuts that are now off the table. So they could be back on the table, in your view?
Well, I don't know, again, but,
It's good to be a technician.
I know.
Things are terrible.
That's what I mean.
Right.
So the recession's off the table now, now one can happen, since no one's expecting it.
I just look at it from a technical perspective, from a trend following perspective, and it's been really helpful over time to judge these momentum shifts, and it's a pretty meaningful one at that. 5% psychologically significant, that makes sense as well. So we want to, sort of view this relief rally that we have seen in yields as something that will be temporary, somewhat fleeting. The resistance for the 10-year is roughly 435 to 440. So below that level, we're looking for them to roll.
So at 25,000 on Bitcoin, you said, well, it looks like we do 30, and then if we get through 30, 36 is next, and we get through 36, and it all happened leading up to the ETF, which happened at about 47,000. What was that for the last month after the ETFs? There's some selling on the news, consolidation?
There was definitely a sell the news event there, and we got a proper pullback out of the cryptocurrencies more broadly. And actually, we saw that shift, remember, into Ether in relative terms. I thought that was interesting. Both Ether and Bitcoin have avoided what could have been reversals of their intermediate term uptrends, not the long-term improvement, that's preserved, but they were testing some support just really over the past few days. So this rebound that we've seen preserves that support and tells us that risk-on sentiment is still very alive and well in that space.
Is copper interesting now? What's happening?
I want it to be interesting, and I'm watching a long-term triangle formation that looks like it's trying to resolve to the upside. The long-term metrics have improved to some degree, but it's really not a confirmed breakout or anything decisive yet that we've seen. So we're watching and waiting to see how that triangle resolves.
Katie, I'm curious, we've been through much of earnings season, and it is not uncommon nowadays to see huge spikes on the back of news. And I'm wondering what your take is on this, and if there's any sort of significance. It seems to happen across. I mean, you had Meta, you had GM, you had Expedia last night. It seems like every single night there's these ARM, of course, massive moves.
And Cloudflare, I think, today.
Right.
It is wild. So the uptrends have given way to gaps up. And usually when you see a gap up in a strong uptrend, it can be exhaustive. But what we've seen from this market is that the gaps are being preserved. So Meta is a great example of that. It hasn't fallen back into the earnings-driven gap up. And that suggests that momentum's strong and that prices can go higher. So we like to look at that gap after an earnings report or something of that nature
Tesla or Apple?
As support.